In this video, we will talk about, can you trade options with a small account? I know many traders who get interested in options, but they don't know where to start or what kind of money do they need to trade options. Sometimes they hear that options are risky. So, an example I'm giving you today is an account with $2,500 in it, but this could apply to an account with $1,000 too. So let's start by taking an example of, if you had $2,500 in your account and you wanted to buy stock, shares. So forget about options. Let's just say how you would invest that money in stocks. So the example I'm giving you here is, let's say you really like Costco and want to invest in that company. Now you have $2,500 in your account and you look up the price of cost, um, and it's $460 per share. For a small account like 2,500, to buy one share would represent 18% of your portfolio value. Now, if you have read any book on investing, everyone tells you trade small, diversify, do not put all your eggs in one basket. Now, taking one trade which risks 18% of your portfolio is an absolute no no. So, let's again go deeper into what is wrong with just buying stock in this case. So, first, you are risking a huge portion of your portfolio with a single trade. Next, if you look up Costco, Costco has never traded above $600 per share in the last 10 years. Even if it goes back to its all time high in the next 1 year, here is how your profit and loss calculation will look like. So, stock, you bought one share of Costco. Costco is at $600. You paid $460 to buy that one share. So you made $140 in profit in a year. That's a pretty lame return for risking such a huge part of your portfolio. And remember, Costco can go down too. This is just like the best case scenario where Costco not only went up, it went up to its all time high. In the previous example, we considered buying stock, Costco, a share of Costco. In this slide, let's talk about something called an option spread. Let's just focus on comparing how much money you're risking versus what your returns are. So, um, if you were to buy a $5 wide at the money option spread on Costco, now again, do not pay attention to the jargon. What is $5 wide? What is at the money? What is option spread? But just focus on the risk versus reward. So again, if you buy a $5 wide at the money option spread on Costco, that will cost you only $250. If Costco, this is the interesting part. So in the previous example, we were saying if Costco goes up to its all-time high of $600 per share in the next year, then you will make some profit, right? In this example, what I'm showing you is, if Costco goes up by just $5, so you spent $250 to buy something called an option spread when Costco was at 460. If Costco goes up by just $5 in next 1 month, in 30 days, you will double your money and pocket a cool $250 in 30 days. I hope you're seeing the huge difference between options and stocks. Even buying a single share of Costco was costing you 18% of your portfolio's value. Now let's dive further into what is so cool about this trade. So, first of all, you are risking only 10% of your portfolio with a single trade. Compare that to 18% with Costco. You need Costco to move up only $5 in your direction to profit from this trade, not a $140 move as in the previous example. We just need a $5 move. if Costco goes up $5, and Costco typically goes up and down up to $30 each month. So it goes up 30, goes down. That's pretty normal for Costco. And we are expecting only a $5 move. So if it goes above $5, you will double your money in 30 days. And many times it's actually less than 30 days. But in this example, I'm giving you a 30-day example. Now, you might say that even 10% of your portfolio in one trade sounds too big, even though you're doubling your money in 30 days or less. So let's address that. Yeah, I agree. 10% of your portfolio in one trade is still too big. So let's see, is there any other option? So if you remember in the previous example, I mentioned something called a $5 wide spread. So in this example, let's explore something else called a $1 wide option spread. Now, to explain that, I'll just say instead of Costco, let's pull up the ticker symbol SPY, which is simply an ETF which mimics the S&P 500. So if you pull up the option chain on SPY, you will be able to buy a $1 wide at the money spread for only $50. Now, as in the previous example, if SPY goes up by just $1 in the next 30 days, you will double your money. I mean, that is really, really cool about buying debit spreads. You only need the stock to move up slightly and you can double your money. Now, this trade represents only 2% of your portfolio. So, which is awesome because now you're not risking a huge part of your portfolio in one trade. And by doing that, you can take many trades, many $1 wide spreads on different equities. And that way you're diversified, you don't risk too much with one trade. And let's just take this example. If you do only 4 trades per month, 1 trade a week, like this, and you have a 70% win rate, here is how your annual return will look like. So you took 4 trades per month times 12 months. So you took 48 trades per year. You have 70% win rate. So that would be 34 winners and 14 losers. Now 34 winners, if you close them at 94% profit, although these trades typically yield 100% profit, but I'm just giving a 94% profit example because that's what I do in my account, and to avoid something called option exercise and assignment. But let's not worry about that. Let's pretend that you are closing all your winners at 94% ROI. That would add up to almost $1,600 in winners. Now you had 14 losers, and one of the principles I follow is I close my winners at 94% ROI. I close my losers when they hit 50% loss. So if you close the 14 losers at 50% loss, that would be $350 in losses. If you just do the simple math, that is a 50% ROI in a year. And remember, you are risking only 2% of your portfolio. So if you read my book, I have mentioned that when the market conditions are favorable, I risk up to 30% of my portfolio in the market every month. So if 2% can return 50% ROI, imagine what a bigger exposure can do to your account. Hope that example helps in understanding why options are so great compared to just buying stock. And if you want to find out more, you can either go on Amazon and look up my book where I have explained my entire strategy. It's called Mean Reversion Trading Using Options. Or you can just go to my website, tradingextremes.com.